So it's been a while since I've actually published anything. I'm going to re-record the beginning of the video to be a bit more energetic because you're gonna see the first steps of the analyses of Nebius and CoreWeave are going to be a bit slower, kind of toned down because it was 12:30 a.m. I had to, be a little more quiet, and I just came from like a barbecue and all of that. But either way, I'm just going to re-record this part for you guys so it's a bit more energetic, and then I'm going to continue the analyses the day after. Actually, I've got to work on my tone and my energy, especially when I want to take this more seriously, because I want to, as I will say in a second, grow a portfolio of my thinking skills as I've started to do it on LinkedIn. And I've actually got a big product coming up that I've been working on for the past 3 or 4 months. We're at the kind of finishing stages of the product itself. We've got the landing page ready. It's just now the issue of setting up the domains and the legal kind of stuff with a legal entity and the policy. So we'll get that figured out. But either way, again, welcome to the video, and I'll just start off the context, and then we'll get to the analyses of the two companies themselves. But I believe the context, the thing that has happened on Wednesday, namely Micron's earnings, have been a total game changer, and I will say why, but it's honestly amazing. I'm actually going to rotate money from Celsius, which is a kind of consumer discretionary value growth play, into those stocks, because I just believe that I can't wait, and I'm going to have to be a part of this. It is that serious. So enjoy the video, guys. I wanted to discuss what has shocked the markets, me, and pretty much every analyst on Wall Street, and that is the scale of the physical AI build-out. I've actually decided to dig deeper, and it's something unseen, especially at those rates. But then you've got Micron, which with the revenue of $40 billion in a single quarter, has tripled it from the year before, almost quadrupled, really. Going into Micron's earnings, I thought that they're going to have a blowout quarter, obviously. However, I never really expected it to be such a magnitude. And this just proves, along with their backlog, they announced 16 customers that they're going to have contracts with beyond 2027, probably 28, 29. And it shows that the build out is really serious, is actually tangible. And if you take into account the rates at which Google and Anthropic are ready to pay, actually Anthropic took the GPUs from Elon Musk at twice the normal market rate, and then Alphabet, Google, took 3 times that amount. So it's actually 6 times the market rate. And I do not believe this is indicative of a bubble. I mean, the sheer multiples that they're paying, because they obviously just want the compute. They want to get ahead of the competition. They want to get advanced in the kind of possible compute as fast as possible. Number one, because GPUs are going to be more and more expensive, compute is going to be more expensive, and the GPUs have proven to be reusable, because OpenAI's GPT-5 model was much more efficient on H100s, the old NVIDIA GPUs, than GPT 4.0. So it all revolves around tokenomics and how it's going to be managed. Either way, I'm going to paste the old part of the analysis now, and we'll see each other in about 10 minutes or something, because that is a deep dive. It just proves that the rate at which the assets are currently being depreciated, namely about 5 years for a single GPU, proves that it's quite a rapid deceleration, and that obviously inference based on GPUs but also CPUs and memory is going to be probably a longer term solution, just because of the fact that we need it. And based on our theses, it just shows that the assets shouldn't be depreciated at that rate, which obviously boosts their net income. That boosts EPS. So I'm actually looking at the two companies, Nebius and CoreWeave. CoreWeave is regarded as the platinum kind of tier of AI compute, the Neo Cloud. just because of the quality and the pace at which they can deliver and build out the data centers. And then we've got Nebius, which obviously takes a bit different approach, which is based around owning the actual infrastructure and the verticals connected to it, creating an ecosystem for companies. And so obviously Nebius has a higher amount of growth currently, and hence it's valued at much higher multiples. Right now, EV to sales for Nebius is 70, I believe. CoreWeave is 14. So it's literally 5 times cheaper, strictly looking at what we've got now. It's quite a difference. It's quite staggering, but it all comes from different factors, and I want to cover them. Just so you know, I'm probably gonna buy both CoreWeave and Nebius. However, I am leaning towards CoreWeave more, at least at those prices. However, obviously Nebius is currently being framed as the biggest winner, which I believe is credible because of the way management has structured the company. Obviously, what they're doing is quite specific and amazing at the same time, especially the concept of vertical integration. We can see that Nebius has a much higher year-over-year growth in terms of the total group's revenues, but mainly the AI business being up 841%. That's staggering in my opinion, but obviously they have lower revenues than CoreWeave, 3 times lower basically. But you know, at this rate of change, they're obviously going to catch up really quickly theoretically. Now, you can see that the strict backlog of customers in CoreWeave's case is 2 times higher. So you have to know that the main differences between how CoreWeave and Nebius earn their revenue is through the business model, really. CoreWeave is comprised mainly of take-or-pay commitments, and this is a much different model than the typical kind of what you would imagine with tokens and AI, API usage, whatever. It is a contract-based model where you just commit to paying a certain amount regardless of how much you actually use. It's a model where it provides CoreWeave with safety, theoretically, because they already get the money and they have the deals secured, basically. At the same time, putting customers at more risk, because if it turns out that models are too efficient, they're going to waste money, theoretically. However, both Micron's results and the AI buildouts now prove that we have a long way to go, and the neo clouds are going to basically be needed for literally everything, even robotics, because that's how you're gonna um, provide physical devices with AI, at least for the first innings, most probably. You have to remember, I mean, you have to note that 30% of current CoreWeave customers are less solvent, or as they call it, I believe, non-investment grade counterparties. And obviously, the CEO himself has said that their balance sheet is investment grade. You'll see that it's not. However, it's obviously a risk because 30% of the current customers are junk rated theoretically. They are non-investment grade, so the solvency is a real issue unless they use the entire capacity that they project to spend, I mean to purchase. They will likely have an issue with paying those contracts back. So it's the second biggest risk for CoreWeave in my opinion. But the biggest kind of issue with CoreWeave is obviously their entire debt structure. They have $25 billion in debt right now, and they've been issuing debt like crazy. And I mean, it's obviously understandable, but the main issue with that, you can see that the long-term debt has basically tripled in a year. is the interest that it's bearing, and those are basically corporate junk bonds. The main issue with that is obviously that they have $500 million in quarterly interest expense. So that's $2 billion a year at a market cap of $55 billion. So they're basically committing almost 4% of the entire market cap, not revenues, market cap, to interest. And so what I said before obviously is heavily tied to this right here. The customers of CoreWeave and their solvency determines their revenues, their cash, and hence the ability to meet interest. And this is what ultimately determines the solvency of the company in itself. And obviously, the CFO of CoreWeave in the Q1 call has said that there are no material debt maturities until 2026. So they might roll or refinance or issue more debt actually to be able to finance the repayment of bonds, because you cannot just roll out bonds. I think they're in a relatively stable situation, and obviously we're taking on a lot of risks. However, CoreWeave is the most established player and the highest quality name in the game. So it's all dependent on the customers, and that's one of the numbers I will be watching the most closely, obviously. Okay, so now we're going to cover a few notes from Nebius just to show you the difference in how they operate, the difference in the metrics they have, and the vision that they have for, let's say, 2030, just to make sure that we have a continuous kind of supply of a backlog that provides us with revenues and hence gives us an opportunity for both growth and then increasing operating leverage once we get out of the debt issuing and can pay off the interest with contracted power. Now, the difference between contracted and connected power is basically how many deals we have for everything within the future and how much of that is active. Now you can see that Nebius has exceeded the 2 gigawatts target a year before the goal of 2.5 gigawatts. They wanted 2.5 gigawatts at the end of 2026, and they had 2 gigawatts in Q1 2026, and hence they raised their guidance to 4 gigawatts during the Q1 earnings call. They're obviously selling future capacity well in advance, which is why they have massive cash inflows, due to the fact that customers want to prepay for a place within their order book. And they've actually said that every single build we sell, it's directly from the earnings call, which just proves the point of strong demand and Micron's earnings from whence they confirm it. Now, you can already see that the company is certain to boast an operating leverage, with revenue being up by 684%, with the cost of goods sold up by 320%. Obviously, it doesn't include the current capex, and just so you know, Nebius actually offers equity raises rather than debt, which we will factor into our model, and you will see how and why that changes the price target and how we approach the price target really. Obviously, they have a great customer book with Meta and the $27 billion contract, dollars of course. They actually claim that they have $12 billion from Meta themselves for contracted power, and then the rest of it is basically an agreement where if it is not fully used by Meta and they have available space, they can sell it later for other customers, which is a kind of hedge against what I said happens in the CoreWeave's customer book, and the risk that some may not actually use all the power because of solvency or simply efficiency of the models, right? Microsoft also has an agreement where they provide financing for the cloud. But what's important is that Nebius, with their contracts with the hyperscalers, actually has a unique advantage where they get low financing at 1.25 and 2.6%. And obviously they are way below the market rate, and that's a major advantage because the hyperscalers are literally willing to lend them money in order to keep a place within the book, as I said. They want to increase capex in Q2, and hence they are saying that EBITDA is going to dip in Q2, but then rise to those levels seen in Q1 and higher in Q4. You can see that adjusted EBITDA is up by almost 100%, up from Q4, and so it's up almost. It's basically doubled in a quarter. Obviously because of the revenue growth, but this just shows that the operating leverage is there and it's actually real. The cost of goods sold is also 30% rather than 60% of the revenue, while product development is 23% rather than 91% of the revenues, with R&D being up 85% year over year, which shows that they have a massive advantage because they have the tech, they have the verticals, and through acquisitions rather than trying to do everything on their own, they simply are faster and more efficient with their profit margins. If you don't know, the average time to build out a data center is about 3 years, and Stephanie Link yesterday, or maybe no yesterday, on CNBC has said a very interesting thing. Stephanie Link has been covering industrials for 35 years. She obviously knows what she's doing. Industrials throughout history have been experiencing 5 to 10% of quarterly growth on industrial and power backlogs. Now it's 35 to 40% quarterly growth, and it's said to be only re-accelerating. That's the effect of companies like CoreWeave and Nebius, but it just shows that it's actually intact, it's actually taking place, and they're not waiting. They have to build it out because both Nebius and CoreWeave have to create connected power to satisfy the contracted power. And I actually wanted to pull it up with Gemini. CoreWeave wants over 5 gigawatts of power by 2030, which would be a 50% increase from the current contracted power. And depending on the prices of the power and the deals, assuming the prices stay the same, the backlog would be 50% higher. In CoreWeave's case, it would give them a $150 billion backlog. And considering the fact that they want 30%, 35 actually, percent of the backlog to convert in the next 2 years, it provides them with an additional $35 billion of revenue. Obviously, the backlog is only what's reserved, and while they might not have a lot of place for contracts currently due to simply not enough supply, it provides stable revenue growth in the long term. Okay, so this is actually the day after. I wanted to make sure everything that I said was right, and it is. I've edited the video, and so now we're at the stage of the price targets. You can already see the price targets. It's 2027 kind of optimistic assumptions, which I believe are very fair, especially considering the magnitude that Micron has introduced to the game. Pretty much every assumption here is in line with what Wall Street projects. Only the revenue is 10% higher compared to Micron's over 20% beat. And so let's start with the adjusted EBITDA, because this is going to be essentially how we're going to value the companies. The enterprise value divided by EBITDA as a multiple. It's of course a forward-looking number, so I took into account everything based on my assumptions for 2027, as I said. And so, okay, so starting with the adjusted EBITDA margins, we're assuming 65% for CoreWeave. They're at 56 right now, and they've guided for higher margins in the same way as Nebius did. So a dip in Q2, and then them coming back and going even higher. And for Nebius, we have 60%, which brings us to 15.6 and $7.2 billion CoreWeave Nebius. Then we're applying the EV to EBITDA multiple, which is going to be 12 for CoreWeave due to the balance sheet concerns. The industry average for now is 14, so it is at a slight discount in terms of the sheer multiple, but with more optimistic numbers. If we wanted to say it is fairly valued, you can see the price target increases quite a bit, but we're going to assume it performs very well. However, the market doesn't treat it in the most perfect or optimal way, even considering the future outlook. We just want to make sure that we're pricing in actual performance, however, taking into account the possibility of concerns with companies like Nebius. You'll see they will most probably have a cleaner balance sheet either way down the road. Okay, then we've got interest expense. It doesn't actually factor into our valuation, but we're assuming 4% for CoreWeave, $4 billion of interest expense per year. Yes, this is a lot, but it is actually a bit higher than the 7.2% rates they have on their bonds. You can see that we're assuming they're going to have $50 billion in debt, which I feel like could happen just to fund the capex, because the expected capex is 35 at the high end. However, we're just gonna say it's 36, just for the sake of them exceeding the costs a bit, which is actually not the optimistic kind of number in terms of the investment theoretically. However, we just want to stay safe and make sure that the cash flow is not really exceeding 200% of the revenue as it did in Q1 2026. We want to make sure the number is quickly coming down to 150% in this case. For Nebius, obviously, is going to be 200% of the revenue. They've actually guided for it in their earnings call, and the expectations from Wall Street are 11.6 billion at the high end. However, let's say they're going to beat it. If they were to beat it by, say, 10%, it would be a bit higher. However, we're just going to stick to 12 for now. Then the interest expense, extremely low because of the 2.6 and 1. I can't remember now, but the extremely low interest rates in their financing. We're assuming $20 billion of debt, more than a doubling from now. Currently, CoreWeave has $2.2 billion of cash and Nebius has 9. So we're actually assuming CoreWeave normalizes their cash position with possible equity investments, and CoreWeave simply not even doubling what they have. In terms of share dilution, we're assuming that Nebius is going to dilute their shares by 10% in 2027, just because they're not taking as much debt, and at the end of the day, they're issuing that in convertible notes. So basically, debt that can be converted into stock, which then dilutes ownership. In terms of the annualized revenue run rate, we're assuming a doubling from what is expected for 2026, $36 and $18 billion respectively, which at the end of the day brings us to this. On the EV by ARR metric, just as a sanity check, it is made with Claude. I asked it to do the model because I couldn't be asked to not use AI. It saved me like 15 minutes, whatever. You can see that CoreWeave is still going to be less expensive, Nebius being 20% more. The forward price to sales of CoreWeave is 4.16. Compared to the industry 3.26. But then in terms of the current EV to EBITDA projections, CoreWeave is actually below the industry standard at 11.67. So Nebius is actually, in terms of the forward price to sales, at 18, which is much higher than CoreWeave due to the intense growth and the premium, obviously, for Nebius's vertical integration that is priced in. Okay, so you can see that CoreWeave is clearly the winner in terms of valuation. In terms of providing the service, CoreWeave is still at the top. My conclusion is that the market prices in the fact that Nebius has a much higher potential for even higher future operating leverage due to the vertical integrations, with CoreWeave's main concern being the debt servicing and the interest expense. However, I actually bought CoreWeave and Nebius at a 70-30 split, 70% CoreWeave, 30% Nebius. I believe that at the end of the day, CoreWeave is at a much more compelling place due to the main risk being financial or liquidity related, and Nebius having a lot factored in, and the main risk being sheer operational execution, especially considering the fact that, I mean, this is both a pro and a con. They're fully dependent on their infrastructure, so of course if they succeed, the EBITDA margins adjusted and the normalized ones are going to be obviously higher. However, I am leaning towards CoreWeave more heavily. I checked it. You theoretically can roll out bonds, I mean just refinancing them with debt. And while it doesn't help with the balance sheet, I believe CoreWeave will be still the dominant infrastructure provider, with Nebius being the operational winner if everything goes well. Of course, I am not a financial advisor. This is not financial advice. Please do your own due diligence and commit only when you're ready, and make sure that you know what you're buying. Never take anybody's advice. Always take advice with a grain of salt, because there might be mistakes, there might be skewed perceptions, and make sure to make decisions on your own.